what I suggested is that, first of all, the disparity between the gold and the gold price was easy to understand. The central banks were buying gold, and central banks don't buy gold shares. So it makes sense that the follow-over wouldn't happen in the gold shares. But we also talked about the fact that for the gold shares to begin to participate as stocks, they had to participate as companies. And the margins that gold producers enjoyed didn't match the increase that one would have expected with the increase in the gold price. That's easy to understand because at the same time that the price of gold went up, the price of inputs, the price of cost to produce the gold went up too. Social rents in particular have increased at 20% compounded. Labor has increased, energy has increased. What you are coming into now, however, is a period where the companies have done a reasonably good job at cost containment, and they are beginning now to enjoy the increase in the gold price and increased margins. In the next 4 weeks, we're going to have a lot of quarterly reports. And I think we're going to have a lot of upside surprises in the near term, particularly with companies that have traditionally been good on the cost side. The Agnico Eagles of the world and the royalty and streaming companies, the Wheaton Precious, the Franco-Nevada. But I think that you're going to see it come down into the secondary tier too. You've already seen an absolute blowout quarter from Lundin Gold. And I think that you're going to see, with increasing frequency, gold mining companies on all ends of the size scale surprise to the upside with the quarterlies. The only way companies are going to be able to grow in the near term isn't with the drill bit, and it isn't with the bulldozer. They're going to have to grow on Wall Street and Bay Street. We've already seen mergers and acquisition through the space. And I think the pace of that, as margins increase and as the cost of equity capital perhaps begins to fall, I think you're going to see a lot more M&A activity.
Okay, and I guess, yeah, if you go back to, this is in gold specifically, but there was Anglo America was, yeah, almost bought, or BHP was trying to do the hostile takeover. So there is these, as you said, there's these resources that people want, and people will sort of are going to start paying for them.
And we're seeing that across the resource sector. The gigantic takeover of Pioneer by Exxon, expanding Exxon's footprint in the Permian Basin at the same time that they're developing offshore Guyana. The takeover of Hess by Chevron, as you suggest, the mooted takeover by BHP of Anglo. You're seeing consolidation throughout the natural resource business. You're seeing it because margins are increasing. In other words, guys can afford to do these takeovers. You're seeing it too because there are economies of scale. Larger companies have more liquid stocks and hence higher share prices. And there's a dichotomy in cost of capital between the very large companies and the rest. The guy with a lower cost of capital wins. That's what happens. And you're seeing it too because of the long lead times that are necessary. In order for Exxon to replace production, it's difficult to do it with the drill bit. They have to do it with acquisition. And acquisitions are uniquely attractively priced now relative to both the cost of capital and the future trend, I think, in commodity prices and commodity cash flows.
Yeah, that's possible, especially when your company is fully valued or even potentially overvalued first. And I think that's what Exxon's really good at, using the equity once they're at that stage to grow. And I think if we go to maybe, and I'm not sure if this is mining, but I know, with my experience in oil and gas, that they're really good at cutting costs when times get hard, but they're very bad at cutting costs when times get good. And normally it's sort of the boom bust cycle in costs similar to the commodity price. And then it's when you actually see that shifting and when you see them being a bit more responsive.
Well, it's particularly pernicious in the mining business. Where you see it is during times when metals prices are low. You'll look, if you're careful, at the difference between the reserve grade, which is to say the average grade of the company's total reserve and resource package, and the mine grade, which is to say they mine the higher grade materials during periods of low commodity prices. They produce for cash. And often they account for this on a unit of production basis rather than on a reserve basis, which is to say they don't report the true depletion and the true depreciation that they're experiencing at the mine face. And what that means is that irrespective of what they do in terms of cutting costs and operations, their cost on a unit of production basis goes up because they've high graded the deposit. This is fairly subtle, but it's something that's happened again and again and again in my career. When I look at periods of low commodity prices, and all the companies do it, what you see is that they mine high-grade material to generate cash. When that high-grade material has been taken out of the ore body, the average material has a higher cost relative to the minerals extracted from it. So that even if commodity prices go up, the cost per unit of production goes up because they've already taken a lot of the good milk out of the deposit.
Yeah, it's interesting. Not something that I'd thought about before. But yeah, Rick, thanks so much for your time today. We've sort of gone in lots of different directions.